Bias Trading here, and today we're going over why it is necessary to frequently use the bid and ask in futures for entries. Now, my girlfriend actually asked me this question recently, and I thought it would actually be a good short video topic on why, for futures at least, I only really use the bid and ask for entries. Now, what is the bid and ask? The term bid refers to the highest price a buyer will pay to buy a specified number of shares of a contract at any given time. The term ask refers to the lowest price at which a seller will sell the contract, and futures contract pricing is divided by quarters, thus 0.25, 0.5, 0.75, and 1, and so on. So why enter using them? Futures liquidity on the DOM or slash order book can fluctuate quickly. That is, if you are unlucky or unaware of the change, you may hit the market buy order and be filled a point or zero point 0.5 away from your entry. 5 minutes before a major announcement is a common time for liquidity to decline dramatically. You can find these on the website listed below. I'll leave it in the description as well. During lunchtime and on days approaching a holiday, such as recently, the liquidity was so much lower going into Thanksgiving. So for the rest of the time, can I use a market order? I would still recommend using the bid and ask because it improves your entries. 0.5 of slippage may not seem like much, but with one ES contract, that is $25 of additional risk you're just putting on the table if you get slipped by a small margin. Here is what an average DOM would look like for ES. So you can see there's 14 contracts currently. On the ask, there is 12 contracts, and so on if you look at both sides. You can see that there will be around 10 to 13 contracts available to buy or sell at any given moment. Most traders will look for entry points at inflection points, for example on a daily level, and these daily levels are frequently swept. This means someone will have a large order and will come in and grab all the liquidity while skipping the price up 1 to 2 points, sometimes more. I've seen 5 to 6 points and it hasn't even been like a news event. Hopefully you can understand why if you had placed a market order on that level, you may have been slipped more than 0.5 points. And this can dramatically change your risk if you get a market order on one of those levels and you get 2 points of slippage. That's $100 on one contract that you've just added to the risk, and it can really mess up your trade. If you're not ready to risk, well, I don't know, if you're not using 10-point stops, 1 or 2 points can really hurt you. And even if you are using 10 points, it's just additional risk you want to not have like forced upon you by slippage. Now for exits, personally I can understand the value of always exiting with the bid or ask, but I am more of the mindset that I would want to click once and be certain that I'm getting out of that trade. Yes, this does mean I'm sometimes losing, half a point, or I don't think I've ever lost more than half a point. But yeah, there is the possibility if you're not using the bid and ask, you could lose some due to slippage as well. If you're looking for scalps of less than 2 points, you should aim to only use the bid and ask, but this is something you should test. This is just in theory. I've never scalped for 1 or 2 points, unless I'm just like getting out the trade anyway. But if you are going for less than 2 points, that extra slippage on a market order could really hurt your profitability. But that is a bit of a separate topic about how profitable scalping is in futures. Thank you for watching, and if you enjoyed, please like and share it with anyone else who might be interested.